So I know today we're going to talk about DSCR and BRRRR. And so I guess I should just come right out and say it. I still really have no idea what those are. So
That's
can you
fine.
break
That's
it
fine.
down for me from the beginning?
Well, and I think we're going over this today because over the last 2 weeks, we get about 10 or 11 to 15 calls a day. And the fundamentals and where you start and what you do and how do you make sure it's successful just keep popping up. So it's a great conversation just to go over some of the fundamentals of the numbers to make sure people are getting into good properties.
Well, that makes sense. Like,
Yeah.
I think it's helpful for repetition too. Like, I know we've had conversations about it, but like for the viewers as well, it's like, if you need to come back and review stuff, that's okay. Like, I'm there with you. Like,
Yeah.
I get it. Like, I need to go back and learn again, what is DSCR, what is BRRRR, even though we've talked about it before.
And I think, yeah, and it's one of the things that we see in real calls in real life are people like we had a person, like, hey, I'm buying this property. And it's like, okay, is it cash flow? They're like, I don't know. I don't know if it'll cash flow. Do you know what you have to put in there? I kind of know, but the house looks nice. I mean, there's all kinds of different investors out there, but the one thing we should know is the numbers to make sure we're buying something that's not going to be a burden. That's going to actually be a profit. You're going to make some money, and you're going to enjoy having that instead of getting halfway through the process and find out, hey, I can't get a long-term loan. Like BRRRR is buy, repair, rent, refinance, repeat. So if they get to the refinance and they can't get a loan, or they're not going to get enough money to cover their costs, it kind of defeats the purpose of BRRRR. BRRRR is all about getting into properties as little as possible.
Getting your properties for as little as possible?
Little as possible out of your pocket. I'm sorry, yeah. Being able to accumulate portfolios without it meaning you have to put in a bunch of money. It's value add properties, which once again, because this has come up a couple times, investors are like, I don't know what value add even means. And value add is just buying properties that are under market so you could put some value into them, which is the repairs, so they're worth more.
So you can add value, like a property that's ready for you to add value to it.
Hoarder's house, someone hasn't cleaned up the yard, properties that need maintenance and repairs, and the current owners don't want to do it, so they sell it to you. You put the work into it, you put the money into it, now it's worth more. So you've created net worth or equity by adding value to a property that needs some work or some value. Other people like pop tops, which means they expand the house. They make it bigger. That's adding value to a property too.
Gotcha.
Taking land and splitting it up. I mean, like, there's all kinds of ways to value add. But when we're talking about BRRRR and moving into DSCR, you have to understand you need to buy value add properties, which means it's going to take some work. It's going to take some stuff. But then you're going to have to refinance it. Refinance it so you could carry it the long term, so you could make rents, bring in income, make the payments. You don't want a short-term hard money or private money loan where you're paying 10, 11, 12%. You want a better rate, so your cash flow is better.
Okay, so we're looking for someone that for a property that needs some love.
Yeah, and it kind of comes back to numbers, and I go through this with people. Like, when you're looking at BRRRR, you want to look at the end. The buy and all that stuff means something, but where you start is with the refinance, because if you don't know what, number one, your loan to value, you can refinance, because it's typically somewhere between 70 and 80%. It's different for each person and each property. And I say for each person and each property because if I have DSCR, you may have, number one, your credit score might be lower, so you get less, or just the property rents can only cover a certain amount of a loan. So, because DSCR is based on what they call a DSCR ratio. So, and all DSCR ratio is, where does it break even? Where do my expenses equal my income, which is my rents? Someone might get in, they buy something, and they're at purchase, rehab, and everything, they're at 80%, and they're using a DSCR, but the property itself only qualifies for 70% because their break-even point, because of their rents, their expenses, taxes are going up everywhere, insurance, all these different things. Their break-even point is only 70% because they didn't do the work, they didn't verify and run through some of the DSCR numbers before they buy, because they're like, I got a great deal. Bought it, into it at 75 or 80%, I should be able to refinance it. But they need to look at that property and have their lender go through all the numbers up front so they know they buy it and they rehab it and they rent it. Now they can refinance it. A lot of people get into that refinance and it's a shock. They're like, I didn't know I could only do 70%. I didn't know I could only do 75, or the
What does that
numbers
mean?
went-
They only know they didn't realize they could only get it refinanced at 70%. You walk me through that?
So when you own a property, you can get a new loan, which in our case in BRRRR, we want a long-term loan. We want like a 30-year typically loan. So the interest rate's not moving. We want a fixed rate so it's not moving and stuff. In BRRRR, you usually buy it and rehab it with a fix and flip loan or fix and hold loan, something that is temporary, like 6 to 12 months, has a higher interest rate. But after 6 or 12 months, that loan balloons, so you have to pay someone off. So BRRRR was all set up for 2 loans. I'm going to buy something that needs work. I'm going to put the work into it, and then I'm going to get a long-term loan. But this whole process of BRRRR comes down to I'm going to buy a property that's undervalued, gets a good equity. I'm going to put a renter in there. I'm going to refinance it. Then I'm going to make money. But too many people are not doing the research up front to make sure, number one, that when they get their long-term loan, it's going to actually make money. Because what if the rates are higher? What if you have to put more money in or your credit's down? I see it way too much, and it's kind of intuitive. You'd think that people would make sure they're going to make money on this before they bought it. But too many people are not, because they're like, I got a great deal. And I've had 2 or 3 people do this where they call me and they're like, I went through this program. They told me to buy these properties and I got a DSCR loan. Now I'm losing $200 a month. They're like, we didn't know until we went to closing on our refinance, our long-term loan, that we would be losing money every month.
They didn't know until the closing.
They didn't know until the refinance closing because they never did any prep work just to make sure the whole thing works. Because when you look at BRRRR, a lot of people are worried about the buy and the rehab and getting people in, but they assume the refinance is just going to be profitable and they're going to get their money back, all of these different things. And what I say is you have to start with BRRRR and even DSCR with a when you have all the numbers, you have to look at the refinance. What can I qualify for? And with DSCR, it's all about the property and your credit score. What can the property qualify for? Because if property's income, their rents are not that high, you're not going to get that big a loan. People are like, oh, I could get 75 or 80, but if the rents don't cover that loan amount, no lender's going to give it to them. They're going to decrease that loan to value until break-even point, or some even a little bit higher than break-even point.
The lenders are?
The lenders are, because they need the income and expenses to be the same. And if they say, okay, 75%, just for example, is a $200,000 loan. I need $200,000 because I bought, repaired, and that's 75%. So I'm just going to go get a 75% loan. But the rents, the money that they're making on the property, are not enough to cover that payment at $200,000. But the lenders will go like, well, you're not breaking even, so I'm only going to give you 180, because that's where the numbers and work out. So if you're buying something and you're getting into these, you have to start with not just a generic number like, hey, I need to be all in at 75% or 80% on when I'm buying BRRRR. You also have to make sure whatever you're using for your refinance qualifies for 75 or 80%, and I think that's where it just gets confusing. And it is confusing because there's so many moving parts and everything. But if you lay this out and go through it, it's like, I got to buy stuff, I got to rent it, but I got to make sure it cash flows.
That's the key, is like ahead of time, make sure it's going to cash flow. Because if it's not, you're going to have a surprise with your lender. Is that what I'm hearing?
Yeah, people get so into the numbers on the front, like I'm getting something at 75%, which is great, which means you can still sell it or something and make money. But the majority of them are missing the part of, I need to make sure cash flows long-term. I need to actually go out and do the Zillow rents and make sure I know where rents are and I know what taxes and insurance and what loan that qualifies for. You know, as interest rates come down, and it sounds like they still will this year, it gets easier to qualify because a lower interest rate means a lower payment, which means then you can expand that loan amount. But if rates go up a little bit or change a little bit, it could change how much that property qualifies for the long-term loan. And if it doesn't qualify, if it doesn't break even, it doesn't help you as an investor, because now you're losing money. Like I said, the guy who's losing a couple $100 a month. So every month he has a property, and every month, instead of it bringing in money, he has to work a little bit harder and put money into it. Long-term, it might work out, but you can't do too many of those things either.
Yeah. Like, you don't want to bank on the long term too much. It's better to like be making money on your work.
Yeah.
Like for your work.
And I think that's where, you know, as we go through this and everything, it's like reaching out to us, you know, to your lender or whatever, and actually running through all those numbers. It takes 10 or 15 minutes. Like, what's your rents? What's your tax? What's your insurance? Okay, your LTV looks good, but what are those other numbers just to make sure it qualifies for the long-term loan? Not only your credit score, but the rents and stuff too. It's like, how do you help people? And, going through this, I want to make sure we're throwing in like, we can help, lenders can help. If you have a scenario, just reach out to us and just to run the numbers on the long-term loan to make sure it qualifies.
So the best way to do that is either your number or cash flow.
Yeah, just, go to our website or just email mike@thecashflowcompany.com, because it's important before you get into it that well, number one, will it cash flow monthly? Or number two, how much money do I have to bring in when I refinance if I have to bring some money in? You don't want to be surprised at the refinance where you're thinking you're bringing in no money, and now you have to bring in 20, 40, or 60 grand.
You don't think you'll have to bring in money, right? But you actually have to bring in, like you're saying, that 2,400 more. Gotcha.
And that's where people get frustrated. They get confused. They think, something was wrong or the system is rigged or whatever. You have to know your numbers going through. You have to have contingency plans. What happens if this happens? Maybe it gets to the point and the taxes have gone, rents or whatever, then you got to be able to get, it's still a good number, I'll just flip it, or I'll do something else, or bring in a partner with some money. There's options when you do that, but you don't want to get, I think people get boxed in with some of these and they just feel they have to do it when they get to that point. And then every month they're paying, and they finally say, I'm just going to sell it. Then they have a prepay because it's a DSCR. They just stack on issue after issue, which makes frustration in the investing world.
I see, yeah. So kind of knowing what your plan's going to be ahead of time, like making sure that you are cash flowing so you don't, like in the example of a DSCR, so you don't bow out early and have to pay that. What's that called? The early fee?
The prepayment penalty.
The prepayment penalty, yeah. So you don't have to worry about that. But also just just make sure you're cash flowing on the front end. Yeah,
you should make sure you're making money every month. And you should also know if you have to bring in money when you refinance. Those two things should be very clear before or at your purchase.
So if you'll make money every month and if you'll need to bring in more money to refinance, those two things need to be really clear before you do the deal.
And the great thing about it is it only takes, 5 or 10 minutes if you run out to Zillow and do a rent calculator, if you know your taxes, your insurance, if there's HOA or flood. Like, you could take those numbers, call a lender, go through all the numbers, and they could let you know, like, hey, it breaks even or not. Or even if you don't want to do that, like, we have a DSCR calculator that you could put in. You could put all those numbers in, and it'll tell you below, like, hey, it's at, like, DSCR calculations, 1 means you break even. It means your expenses and your income. So if you run the DSCR calculator, which is on our website, thecashflowcompany.com, you could run those numbers on each property, and it will tell you put in your interest rate. So hopefully you get all that information. And it'll tell you if it's going to break even or if it's not. And if it doesn't, that means you're going to either have to lower your loan amount, which means you bring in money, or you lose money every month. I just want to make sure the more and more I talk to people across this nation, we're getting more and more people who understand a little bit.
Yeah.
And they understand the front end, but they have to understand the long-term reason to do BRRRR is to build a portfolio that makes you money and creates wealth. And if you get into properties that are not doing one or the other or both, it just means you're not going to create a portfolio. You're probably going to sell that. You're going to lick your wounds and move on.
So you're not going to create a portfolio. You probably just have to sell, perhaps at a loss, perhaps the prepayment penalty.
Yep.
And then you got to move on, and you're going to be like discouraged. I'm like, what? People said this investing thing was a way to make money.
Yep.
Took money away from me, and
exactly.
Now I'm bitter.
Yeah, exactly. That's what happens.
Yeah.
People go and they get desperate, and like they're like, this was my way out, or work, or whatever. And it's just taking some time. And I know everything is new and numbers are new, and that's where, like, making sure you understand exactly what you need to do and reaching out to people who have gone through this multiple times to help you get through this too.
Gotcha. Well, it sounds like a no-brainer to call you guys and to, you said there's the DSCR calculators on thecashflowcompany.com.
Yep.
And I imagine you walk through this sort of thing with people too. If they're like, what do I, you mentioned the Zillow rental comps. I know there's a video on that.
Yep.
But you'd also be willing to, like, show people how to walk through this process. Because you said it's 5 to 10 minutes, right?
Yeah. We can't probably get their taxes and insurance because each individual, like, especially the insurance, but we could, I guesstimate, but they should just reach out and find those numbers. But yeah, running through, what's a possibility rent and what kind of numbers, because when you run the calculations, what you're trying to figure out, am I close? Am I way above? Like, is my rent so good that I don't have to worry about it? Or is it so tight, I may have to worry about it? Or is it the other end where it's so low that I may only get a 65% loan to value, and it's not because of the borrower and it's not because of the property, it's because of the income generated from that property, because there's multi-facets working here when you talk about that refinance. The number one thing is, especially with DSCR, is income and expenses from that property will determine a lot of your loan to value.
So income and, say that one more time?
So the income from the property, your rents.
Right.
And the expenses, which are your monthly payments, your taxes, your insurance, HOA.
Your rents and all the expenses.
Yeah. So wherever they match up, get close to 1 or a little bit higher, that's going to be where it limits you on your loan amount.
Gotcha. So if they're the same, that's your breaking even. And if it's a 1 to something a little bit higher, that means you're cash flowing a bit. And so that's going to benefit your LTV.
Yep. So
Gotcha.
and put it another way is some properties will break even at 60%. Some properties will break even at 65% loan to value. And some properties will break even at 80 or 85%. So each property is different where that break even point is, meaning where you make money or you don't. And that determines a lot with DSCRs. Where is that loan to value where it breaks even? It might be 67 or it might be 69. But each property may have a different point where it breaks even. And some are cash flowing so good it doesn't matter. But that's not typically what happens. I just did a portfolio for someone who had 4 small properties and a larger. And he was like, I want 75%. But guess what? They only qualified for 70. Not because of him, not because of properties or anything. It's just the income to his expenses and where rates are capped him out at 70.
It wasn't because of him or because the properties are bad. It's just because the income to expenses was, pretty close.
Yep.
Gotcha.
I just want to make sure people understand when they're getting in. It's great to do this.
BRRRR, yeah.
BRRRR and DSCR put together is really powerful as long as you just take a little bit of time and do your numbers all the way through, plan for a few contingencies, and build it and do it right.
Yeah, that makes perfect sense to me. Well, thanks for chatting today.
You're welcome.
Yeah.
Thanks, Mike.
Talk soon.
Yeah, bye.